Alibaba founder Jack Ma, AP photo, Markus Schreiber. Tech companies based in China are said to be scaling back on their deal-making in the U.S. as the trade war continues to escalate. Instead, they're now looking to expand their investments in markets much closer to home. In recent years, both Alibaba and Tencent had committed billions of dollars in acquiring U.S.-based assets as they sought new growth opportunities outside of their own increasingly saturated home market. But now deals like those are tapering off as the leaders of the world's two largest economies continue to trade accusations and slap on new tariffs in a long and bruising trade battle. Amid the increasingly hostile environment, the two companies are instead focusing more on Asia, and oftentimes going head-to-head in their fight for the attention of digital-savvy users in the populous region. Alibaba has already participated in more than $2.8 billion worth of deals in Asia so far this year, eclipsing the $497 million it invested in U.S.-based assets in the same period, according to D-Logic. Tencent, by comparison, has invested almost $1 billion in Asian deals this year, about 4 times the $250 million it committed simultaneously to U.S.-based transactions. More on Forbes, how much blame does Jack Ma deserve for his broken promise? Alibaba founder Jack Ma blames the escalating trade tensions for his shift of strategy. In an interview with the official Xinhua news agency, China's third richest tycoon said Alibaba would no longer be able to create 1 million jobs in the U.S. as first promised during his 2017 meeting with President Trump. He also warned during Alibaba's Investor Day conference that the trade war could drag on for 20 years, and said businesses should prepare themselves for the escalating tensions. The promise was made based on China and the U.S. having a collaborative and friendly relationship, Ma said in the Xinhua interview. The situation now has completely destroyed our premise, so it can no longer be completed. Ma's comments were made amid tit-for-tat trade actions from both countries. This week, the White House slapped tariffs on another $200 billion in Chinese goods, and Beijing retaliated with its own tariffs on $60 billion in U.S. imports. It also dashed prospects for negotiations to recommence, issuing on Monday a strongly worded white paper that accused the Trump administration of being a trade bully. Brock Silvers, managing director of Shanghai-based investment advisory firm Kaiyuan Capital, says that he doesn't expect much U.S. investment from Alibaba in the near term. Alibaba could well decide to focus more on Asian market investments until we see a breakthrough in U.S.-Sino trade, he says. More on Forbes, a guide to Southeast Asia's thriving startup ecosystem for both Alibaba and Tencent. Southeast Asia has become a particularly attractive investment destination, thanks to its proximity to China and growing internet penetration. By end of this year, the number of internet users in the Association of Southeast Asian Nations, ASEAN, is expected to reach 350 million, representing the third largest bloc of users after China and India, according to Jefferies. Online shopping has become an important channel to reach them, with the overall market on track to reach as much as $40 billion in the next 2 years. And the two companies have been steadily increasing their bets in those markets. In March, Alibaba invested another $2 billion in Lazada, a Southeast Asian e-commerce platform, and that follows a late 2017 investment of $1.1 billion in Indonesian online marketplace Tokopedia. Gojek motorcycle taxi drivers and passengers travel through traffic in Jakarta, Indonesia, on Saturday, August 4, 2018. Photo, Dimas Ardian, Bloomberg. Tencent, by comparison, has a 36% stake in Sea, a company often referred to as the Tencent of Southeast Asia. Based in Singapore, Sea offers digital entertainment along with its Shopee online shopping platform. Tencent is also backing Indonesia's ride-hailing startup Gojek, whose GoPay platform can be used for passenger fares, shopping, social media among others. Tencent is building cross-border payment capabilities and social relationships, says Forrester analyst Danny Mew. Social connections are the keys to Tencent's investments. But the expansion has come at a cost. Profitability has proven elusive so far as the companies continue to spend to capture a greater share of the market. In Indonesia, where the online shopping market is expected to catch up with India's by next year, Lazada, Tokopedia, Shopee and China's JD.com have all suffered losses after spending aggressively on consumer vouchers and lowering commission fees to attract more sellers, according to CLSA analyst Paul McKenzie. While there does appear to be some easing of subsidies and while monetization is ramping up, we still see profit attainment at the market leaders as being distant, he wrote in recent research note, adding that the companies and their backers are willing to tolerate several more years of losses as they fight for a bigger slice of the market. More on Forbes, ride-hailing startups Gojek.